Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Josh Lipton, live from our NYC headquarters. Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Clearly, I think the market, again, is clinging on to the positive news, but it's sort of burying the more negative news flow at the moment. I'm not sure how long that will hold. I think what we're in right now is the sort of classic bear market rally stage where, sentiment is so clean, and I think that's what we are seeing.
We're in a better situation today than we were then, because these tariffs, it gives a 1 to 2 month, pause or exemption, whatever you want to call it. And that's also room for negotiation with China. So I think investors are viewing this as kind of breathing room. You're still not going to see any sort of guidance in terms of, earnings and earnings season. But I think this is definitely a step off the cliff relative to where we were the last week.
In the case of Bank of America and Citigroup, they're both very encouraging results. These are both stocks that we are recommending. And I think what in both cases we're seeing is a reiteration of the financial outlooks that we were expecting.
We've got 1 hour to go until the market close. Let's take a quick look at the major indices here. We are lower, edging lower. The Dow down about 85 points. The S&P 500 down about 0.1%. Your tech-heavy NASDAQ also down about 0.1%. Russell 2000, look at the small caps. They're basically flat right now. Of course, investors, kind of a few different cross currents they're thinking through. They have bank earnings this morning, Bank of America and Citi. They're higher right now. We're going to talk to a smart bank analyst later in the show about that and the sector. Also, of course, Trump's trade policies front and center as well. We'll take a quick look at the bond market. We know we saw these massive moves in the market, but looking at the U.S. 10-year, your benchmark holding basically steady here at 4.33. Let's get out to Jared Blickery for more on today's action. Jared.
Thank you, Josh. As we were just discussing before the show, it's almost a reprieve today that markets are a little bit boring. And yes, they're trading to the downside just a little bit, but we are not seeing the 5%, 10% moves in the S&P 500, those 2,000 points to the upside or downside in the Dow that have really shook investors recently. This is a year-to-date look of the Dow Industrials, and you can see over the last few weeks, the incredible amount of volatility we've had, and then over the last 2 days, things have just kind of quieted down a little bit. I'll show you the NASDAQ as well, and you can see the Russell 2000 really not moving that much either. So the NASDAQ down about 13% year to date. I want to show you what's going on with implied volatility. That would be the VIX, and that is coming down. You can see it is trading with a 29 handle right there. I'll put a year-to-date chart on the VIX, and you can see pretty far down from this peak. And intraday, it was all the way up to 60. That's how we began the week last week, and now we are down into the 20s. So progress is being made. We are not in the all clear. By no means has there been an all clear signal just yet, but we are going in the right direction. And then the 10-year T-note yield, that's interesting too. This is year to date. It is off of the highs. Last week we had that blistering 50 basis point rally, but we are just kind of consolidating those moves and going in the opposite direction a little bit. I want to show you the sector breakdown today for large caps. We have financials in the lead. We are experiencing still some bank earnings, especially regional bank earnings. We'll take a look at that in a second. Real estate, tech, utilities, communication services, and energy. That rounds out the winners here. Consumer discretionary and consumer staples, those two consumer groups leading to the downside. I did want to leave you with some green, so I will show you the big banks first. And you can see JP Morgan kind of bucking the trend underwater just a little bit. But I want to show you the regional banks because those are what are reporting right now, and we're seeing a wall of green right here, and so a little bit nice to see that as well. Back to you guys.
Thank you, Jared. For more on the latest market moves, I want to welcome in now Simeon Hyman, ProShares Global Investment Strategist, as well as Brian Levitt, Invesco Global Market Strategist. Guys, welcome to you both. Brian, I'll start with you. It looks a little relatively calmer out there, right, as Jared was just saying today. Not just the popular averages, but 10-year Treasury, Brian, we're holding steady here at 4.33. VIX has tumbled, the dollar firmer. What do you make of it?
It feels a little bit like where we were before Liberation Day, where everybody thought we may start to get better outcomes with regards to the trade conflict. So I think as soon as we put a pause in place, the expectation was maybe we've seen the worst of it. And we probably have seen the worst of it in terms of where tariffs go. Of course, tit for tat conflict with China could continue. But that's becoming more of the perception. My concern is the longer this is in place, the longer the uncertainty persists, obviously the bigger the hit to sentiment, the bigger the hit to investment. I don't think it's a market that's priced for recession. So that's the challenge. Hopefully we will get better news, but we're all a bit on the whims of the White House right now more than we typically are.
Simeon, let me ask you, I want to get your take on the earnings picture as well, because we got more big banks reporting this morning at Bank of America, Citi. I mean, both those names are higher in today's trade. We'll talk to an analyst later about those names. But kind of just bigger picture, Simeon, I'm just curious what you've made of the earnings season so far, lessons learned, obviously with big tech still on deck.
Well, first let's put it in context. Yeah. And the context I like is, let's skip over the great financial crisis because there's so many other moving parts. Let's go back to the turn of the century when we had a downturn that was after a long period of tech outperformance. Here's a couple of points of comparison. We were at 30 PE then. We're at a 22 PE now. But 10-year bond was 6.5 then. So apples to apples, it's almost like 13 versus 15, 16. So valuation's more attractive. And very specific to the earnings point, take the tech sector. The price to book is the same as it was 25 years ago, but the PE's cut in half. That means that the tech sector is generating double the amount of earnings per dollar of book value. So we're coming for some pretty strong fundamentals. And earnings season, we know it's rearview mirror, but it's coming in okay, not bad at all.
Is that your take, Brian, as well? Okay?
Yeah, it's certainly coming in okay. I mean, we'll have to see. We want to see what the guidance looks like, and I think a lot of these CEOs and CFOs are a little bit challenged on that.
Are you surprised at that point, though, that big banks, they weren't like pulling guidance? There was fear that we would hear more CEOs just say, or CFOs saying, listen, I'm pulling guidance. I can't give you a forecast.
Yeah, I'm somewhat surprised, but I suppose I mean, you have to remember the economic setup was quite good. Coming into the year. The U.S. economy was in a good place, inflation was stable, Europe was coming on, so we were in a better place. A lot of animal spirits, still looking ahead to what deregulation could mean, to what tax cuts could mean, but yeah, we're in a bit of a challenge here. I am a little bit surprised that more didn't pull, but more more on the industrial side, more on the manufacturing side. I think the challenges are going to persist.
I want to get the same question to you about earnings. When you think about corporate profit growth, Brian, in 2025, what does it look like to you?
Well, I think it moderates. I mean, I don't think that we're going into negative, a negative growth area, but it's certainly going to moderate. I mean, look, the reality about tariffs is you may say there's a rationale for it, but somebody has to pay for it, right? So it's either going to be a hit to corporate profitability, or it's going to be passed on to the consumer, or in a worst case scenario, both. So we have to imagine that. I mean, leading indicators are pointing towards slower growth. It's going to result in slower corporate profitability. And, again, the market is assessing what that hit is. Are we heading into a recession? We certainly hope not, but policy mistakes, if left in place long enough, can get you there.
Against that backdrop, Brian, I'm curious, in the equity market, what sectors look attractive to you? And have you kind of shifted given all the tariff and policy
uncertainty? I would still be defensive here. In an environment where leading indicators are still
And does that mean staples, healthcare?
Yeah, I mean, I would think more, if I think about it from the factor level, I would think more higher quality businesses. I'd also look quality and adding some value into the portfolio
When you say quality, Brian, how do you screen for quality? What does that mean to you?
Well, I'm thinking about cash flow generators, companies that don't have impaired balance sheets, that don't have to roll debt in the near term. I mean, I think it's less about sectors right now and more about what type of factors we want to be exposed to. And so, what I think is important for investors coming into the year, the hope was we're going to have a broader market, right? And the idea of a broader market was better nominal growth in the U.S. and around the world. And as a result of that, a little bit more value, a little bit more mid-cap, a little bit more Europe. And the reality is that worked, but not the way everybody anticipated it would work. It worked with some of the highest concentration names, highest valuation names coming down more. What's nice about that trade and why I think it makes sense in a portfolio is if the economy rolls over more, you're coming at it from a lower valuation perspective. if we get the recovery, those are the types of markets that tend to outperform in a recovery.
And Simeon, I think last time we spoke, I asked you where you saw opportunity. I think you were sticking with those sort of dividend growth strategies.
Couldn't agree more with the quality point. And for us, an easy way to capture quality are consistent dividend growers. The S&P 500 Dividend Aristocrats, it's our ETF, NOBL, Noble. These are companies that have grown their dividends for 25 straight years. That means they grew their dividends in the great financial crisis, if that's just one proof point for you. And it fits the sector composition. You've got more staples, less technology. They've been underperforming because of the tech run for the last couple of years, and they've got all the things that you mentioned, strong balance sheets, cash flow generation. So that's certainly one way to capture the quality idea.
That's what you like, Simeon. I'm curious what you would avoid here. What doesn't look as attractive?
Well, look, there's a simple one. Energy. At some point, you've got to do the counter-cyclical. You buy it when oil is dirt cheap, but we're still on the cusp of a falling bit of demand here. So that's an easy one. And by the way, look, it's only 3 or 4% of the S&P 500. So it's not like if you're nervous about technology, taking it to zero is too extreme. But you could take energy to zero, it's 3 or 4%. And if you're right, you're going to outperform the S&P by 100 bips. And if you're wrong, you're going to underperform. So it's a prudent thing to avoid.
We went into this whole interview, Brian. I didn't even ask your outlook on the Fed. What do you think Jay Powell does this year?
I think the Federal Reserve is going to bring rates down gradually. I think the most important thing is I think they're ready to respond if there's disruption in the bond market. And clearly the administration seemed willing to respond. And that goes back to the old Carville line about I want to come back as the bond market so I can intimidate everyone.
Right.
I mean, we certainly, I personally would rather come back as Tom Brady or Mick Jagger, but so be it. So we've seen the response. I think the Federal Reserve is going to look through, we're going to have inflation in the near term. I think they're going to look through the price shock if growth deteriorates and if there's disruption in the bond market. The reason for that, I mean, it's the reason why they've always used core when looking at inflation data, because they don't want to respond to price shocks. They want to make a determination on what long-term inflation expectations are going to be. Long-term inflation expectations, at least if you look in the bond market, very contained, which gives them the ability to move as growth slows. Now, do they solve all of our problems for us this time? I mean, they probably give a market boost, but I don't know they solve our problems. We really need to see the clarity come on the trade side.
What do you make of that call, Simeon?
It was very comforting to see some stability on the long end of the curve for as much as any other reason, because what this does is it allows us to continue to view bonds, longer duration bonds, as being in a position to diversify equity risk. We haven't had that opportunity in a generation because quantitative easing brought yields down so low that in 2022, bonds couldn't bail out stocks. From 4.5% 10-year, the idea is if we have a recession, then we'll have 2.5%, 3% on the 10-year, and you make 10% on the ag. And it looks like that will hold for now. Because remember, QE is back in the back pocket of Powell. They can do it again and bring those rates down even below 2.5% or 3% if needed to stabilize the economy.
Guys, that was a great discussion and great way to kick off the show. Thanks to you both.
Pleasure. Thank
Simeon,
you.
you're going to stick around, Brian. Thanks so much. Appreciate it. All right, we are just getting started here on Market Domination. Coming up, United States Secretary of the Treasury, Scott Bessent, joins the program to discuss tariffs and his outlook on the bond market. You don't want to miss that one. Stick around. Much more Market Domination still to come. Now time for some of today's trending tickers. We're going to check here on shares of Netflix, Rocket Lab, and American Airlines. Shares of Netflix, let's start there because they're higher today after the Wall Street Journal reported the company is aiming for a $1 trillion market capitalization to double revenue by 2030. This comes ahead of the streaming giant's earnings report. It is coming on Thursday. So Simeon, Netflix earnings are on deck. Ahead of that, this was interesting. So the Journal was reporting executives were optimistic about the company's growth prospects at their annual business review meeting last month. They were setting some, what sounds like ambitious goals here. So they aimed to double revenue from $39 billion last year, earn about $9 billion in global ad sales by 2030. They got a goal of tripling their operating income by 2030 from $10 billion last year. And I'm just looking here, heading into the report, the stock well in the green this year, Simeon. It's up about 60% over the past 12 months.
This is what I love about this environment, because I'm an old guy, but there was a book in the late 90s. It was called The Innovator's Dilemma. And what the Innovator's Dilemma posited was that companies who were legacy companies would be unable to compete with disruptive technology because they were too wedded to their old way of doing business.
Yeah.
It appears the opposite today. Netflix was a disruptor 20 years ago, but they and other companies that are 20 and 30 years old appear to be in much more powerful positions than the companies that got disrupted in the late 90s. Has to do with the cost required to compete in AI, the economies that eyeballs and just market share gives you. So it is very different than what we saw in the first round of the internet disruption.
We've had some Netflix bulls on too recently, Simeon, who say, even if there is this material economic slowdown, they think Netflix is one of the more defensively positioned ones.
It does seem like one of the last things you would give up. You're stuck on the couch, you're going to watch it. What are you going to do?
Right. Let's move on here. Check out shares of Rocket Lab. They're taking a lift off today after the company landed new hypersonic business in the U.S. and the U.K. The U.S. Air Force selected Rocket Lab's HASTE launch to participate in a $46 billion contract, while the UK Ministry of Defense selected Rocket Lab for its hypersonic technologies and capability development framework. It's a $1.3 billion program. So this one, okay, so the space company, bottom line here, here's your headline, Simeon. They're moving higher, talking about hypersonic testing contracts, US and the UK. I do see analysts at Stifel cited as saying the announcement is another key milestone. They said that with this announcement, they have access to long-term government contracts that extend through 2031. Impressed, they told clients, with the team's progress across several new high-profile and potentially high-value programs.
Yeah, if you ever wanted to be reminded of there's no pure free market, this is it, right? You said it, government contracts. I mean, private companies, government contracts, there's nothing pure out there. So it's always tricky to value companies like this because so much of the business depends on government contracts.
Stock down around 20% this year, but huge move over the past 12 months. And despite that move, still a street optimistic. 9 buys, 5 holds, 0 sells on this one. All right, American Airlines, that's our final one. Let's get a look at that one. It's a boost today after the company announcing that it will launch free Wi-Fi for its rewards members starting in January next year. American Airlines is partnering with AT&T and said the service will be available on about 90% of its fleet by the rollout. So American Airlines, okay, so going to provide complimentary in-flight Wi-Fi sponsored by AT&T. CNN did note, I don't know if this is your experience, Simeon, that this is one of the few US-based airlines still charging for Wi-Fi. They say Delta added free Wi-Fi on most flights in 23. United apparently recently announced that its free internet will be powered by Elon Musk's Starlink. But the stock is higher today. It has been a rough 2025 so far, though. I'm just looking. The stock's down about 40%.
I thought I still paid $8 on United last week, but
you and me both, my friend.
These are, look, airlines are cyclical. Obviously, they're benefiting from low energy prices, but if there's even any whiff of recession and any limitations in cross-border travel, you'll see some pressure there.
By the way, reporting results April 24th, and of course, we got United after the bell today. All right, be sure to scan the QR code below to stay up to date with the best and worst performing tickers on the Yahoo Finance homepage. Meanwhile, Johnson & Johnson tops first quarter earnings estimates, but the pharma company expecting a tariff impact on business. And Yahoo Finance's Anjali Kamlani joins us now with the very latest, Anj.
That's right, Josh. And we know that, of course, tariffs are top of mind for the entire pharma sector. As we know, we heard the announcement from the administration yesterday about the specific pharmaceutical tariffs. Johnson & Johnson sort of bridges two gaps. It also sells medical devices, and that includes to China. So that is where a lot of the impact comes from for the business. Just taking a quick look at the earnings, they did beat on both the revenue as well as earnings per share, but that doesn't seem to really have helped their stock. It's been trading largely flat, but slightly negative all day long, and that's because Wall Street is still waiting to hear about the final impacts. We took a look at what they said during the earnings call, and they said they were expecting about $400 million in terms of impact, and that's largely coming from those medical devices. I had a chance to catch up with CFO Joe Woke earlier today, and here's what he had to say specifically about where that $400 million is coming from. Take a listen.
The tariffs that we've included in that $400 million relate to products that are not exempt under USMCA, some of the aluminum and steel tariffs that currently exist and apply to our medtech products, and then the China tariffs, both from China as well as the retaliatory tariffs that China had levied upon us. That last piece makes up probably about 70% of the total $400 million. So those are products of origin here in the US being shipped to China, and that's the impact that we actually have. So we'll have to see with respect to pharmaceutical tariffs.
So they're still waiting, like the rest of the industry, for the rest of the, the other shoe to drop, essentially. And that's where things stand right now for the medical devices. We've seen analyst notes all day talking about how they have less protection from China in particular, but also the Mexico, Canada, as they mentioned, or as he mentioned earlier about the steel and aluminum there. Looking at what's ahead and how to sort of, wait for everything else to fall out for the year. I asked him how he's thinking about this, in particular, how to, run the company, knowing that the situation is still kind of fluid. And here's what Joe had to say.
My only role, I guess, as CFO at this point would be to look at the profitability of business. If these tariffs continue to escalate, then you just have to make decisions like we would in any other part of our business. And we're currently doing within our orthopedics and surgery portfolio, rationalizing SKUs that are on the less profitable, perhaps even unprofitable side in either certain markets or certain product portfolios. And that would be no different.
So as you can see, just looking at rationalizing the business, and this is already impacting the company, the first of the major pharmaceuticals to report in this quarter. So we'll just have to wait and see how the rest stack up by comparison.
All right, thank you, Anj. Appreciate it. Coming up, China reportedly ordering its airlines not to take any further deliveries of Boeing jets. More on that story when Market Domination returns. Welcome back to Market Domination, sponsored by Tasty Trade as we continue to count down to the closing bell on Wall Street. Let's take a quick look at the popular averages here. Lower, modestly slow. The Dow's down about 106 points. The S&P 500 down about roughly 0.1%. The NASDAQ down nearly 0.2% right here. Just look at the small caps. They are flat in today's trade. Of course, investors waiting through earnings. We had big banks this morning, Bank of America and Citi. They're higher in today's trade, but also, of course, as always, Trump's tariff policies front and center as well. Well, China is ordering its airlines not to take any further deliveries of Boeing jets. That's according to a Bloomberg report. The move becoming the latest chapter in President Trump's trade war against China. For more, we're going to bring in now George Ferguson. He is Senior Aerospace Defense and Airlines Industry Analyst for Bloomberg Intelligence. George, it's always great to have you on the show. So Bloomberg reporting here, George, you saw it. China has ordered its airlines not to take any further deliveries of Boeing jets. What do you make of that, George? And for investors listening right now, what could that mean in terms of financial impact for Boeing? How important is China to Boeing?
Yeah, so not very important anymore. I think this doesn't get in the way of Boeing's recovery. A lot of progress we expect they'll make on it this year. So really since 2018, Chinese airlines haven't ordered from Boeing. Right now there's a little bit over 240 orders on the books from Chinese airlines and Boeing's backlog. That's of a backlog of 6,000 aircraft, so a very small proportion. Prior to the pandemic, China, a much bigger buyer. Prior to the first Trump administration, China, a much big buyer, would usually take 150 to 180 Boeing airplanes a year. Since that first sort of Trump trade action and the pandemic, we've really seen China cut their take from Boeing way down. Even for the total market, they only took in 150 narrow-body aircraft last year. They were largely from Airbus because of the slower GDP growth in the country. So I think there's a lot more. There's a big headline here, but I think the effect isn't that great on Boeing.
Hey, George, it's Simeon Hyman. Historically, I can't think of a sector or a subsector that's more politically intertwined than aerospace. I know we have obviously elevated tariff challenges right now, but is it to some extent business as usual? If anybody's ready for this, you'd think it would be Boeing. They've lived this many times before.
Yeah. So as we think about the tariffs and the effects on Boeing and even Airbus, I mean, right now in the industry, backlogs for the most important airplanes, the A320 from Airbus, 737 from Boeing, 9 to 10 years long. So I think if you're an airline, you might slow down some of your deliveries, ask them to park it while we figure out tariffs. Feels to us like it takes, I don't know, something less than maybe a year to get through some of the negotiations around tariffs. And I think if the Trump administration goes out and looks for countries to equalize trade, Boeing could be a benefactor from that as countries buy more airplanes from the U.S. So I think, again, given the backlog, the international nature of the industry, we're not seeing a big effect right now. And again, I think a tariff game that maybe should last less than a year or something like that.
George, I just want to get your take. Ryanair's boss made some comments to the FT that got some attention. Michael O'Leary, basically, I don't know if you saw this one, George, he kind of warned, listen, we could delay deliveries of Boeing aircraft if they become more expensive. He said, if tariffs are imposed on those aircraft, there's every likelihood we may delay the delivery. I'm just curious what you made of those comments, George.
Yeah, so I think delay, again, is the key word there, right? And we heard Delta do that last week on their earnings call. Delta talked about taking very few deliveries in the back half of this year. Delta, a big buyer of airplanes from Airbus, and they're looking at that tariff cost, right? And so, when this will be the hottest zone, I think, of the tariff battle will be U.S. and Europe. And honestly, we put together fleets in Europe and in the U.S. and thought about the exposure here. And when you look at it, Airbus probably has more exposure in the U.S. than Boeing has in Europe. Boeing's key customer is Ryanair. You pointed it out. Airbus has Delta, Airbus has Frontier, Airbus has Spirit, Airbus has JetBlue. So my guess, again, is that something gets done on the trade front between the U.S. and Europe. But again, you're going to see CEOs, they don't want to pay 20% more for an airplane. I think that busts budgets in a business right now where we see fares kind of sliding and profitability looking like it was sliding even before these problems. So they're going to delay, but they're going to be very, very reticent to switch. It's expensive to switch, and there's a long backlog.
How deep a recession would it take to derail that recovery at Boeing?
Yeah, I think pretty deep, right? I think that if we get, sort of maybe a typically long recession, neither Boeing or Airbus are going to feel it much. But I think you're going to have to get into pretty rough global economic times for the Boeing turnaround that we kind of expect this year to get derailed.
George, final question. So Boeing results on deck, scheduled for next week, April 23rd. You expect to hear what, George?
Well, look, I think all the CEOs are kind of pulling back, talking about much of anything, given tariffs and the tumult I think we've seen recently. We're going to be very focused on where they are in stabilizing production. It looks to us like in the first quarter they were doing at least sort of mid-20s level new production through the factory, not inventory. They were delivering. We're looking for them to rise. That's of 737s. We're looking for them to rise to like 38 by year end. We think that's all part of this recovery. We're going to be very focused to hear on how that factory is stabilizing and how they're starting to boost production.
George, always great to have you on the show. Thank you for joining us.
Great. Thank you.
S&P Global out with a new note on U.S. credit. The firm reiterating the current U.S. sovereign credit rating, but saying it could be at risk of a downgrade amid the current economic uncertainty. For more on what this means, we're bringing in Yahoo Finance senior columnist Rick Newman. Rick.
Hey, Josh. I read this as S&P basically saying, you guys in Congress and in the White House, you really better get it right or another downgrade is coming. So they refer specifically to this budget gimmick that Republicans are considering. It's this thing called current policy baseline. If you're not a politics geek and you haven't heard about that, you probably will if they really try to do it. Basically, that will let them pass a big tax cut bill without counting the deficit spending as deficit spending. So they're basically going to be able to say, it's just basically an accounting trick that says, oh, we're going to have to issue $4 trillion of debt to cover these tax cuts, but by some magic wand, it's not going to add to the national debt. That is not going to please the raters. S&P also referred to the Trump tariffs, uncertainty caused by his migration policies, trying to deport migrants, and just pointing out, the U.S. debt situation just continues to deteriorate. S&P first cut the U.S. credit rating back in 2011. Back then, the national debt was only $15 trillion, and debt as a percentage of GDP was only about 65%. Now the debt is more than double. It's $36 trillion, and debt as a percentage of GDP is 100%. It's only going up, and it just seems like another downgrade is inevitable.
Rick, good to see you, my friend. Thanks for joining us.
Yeah, man.
Bank of America and Citi reporting first quarter earnings this morning, beating on the top and bottom lines and following a trend of strong Q1 bank earnings. From what we're bringing in now, Gerard Cassidy, analyst at RBC Capital Markets, covering the banking sector. Gerard, it's great to see you as always. So listen, the bank earnings, they continue to roll in. Gerard, we heard from Bank of America and Citi this morning. Investors clearly liked what they heard there. Both those stocks are higher in today's trade. Broadly, how would you characterize what we've heard, Gerard, from the sector you know so well? I mean, it has seemed generally positive, Gerard.
Josh, you're absolutely right. The results have been good. The banks have generally beaten all of our estimates on the street consensus, EPS estimates, as well as my own. And I think part of the reason is, of course, the capital markets businesses for the large money center banks and for Goldman and Morgan Stanley were really strong in trading, particularly equity trading. So that was a large reason for the beats for most of these companies. Also credit. Credit remains very resilient, even though they're building up reserves as they're required to do under the new accounting standard called CECL, current expected credit losses. When I say new, it's January of 2020 when it was introduced. So I think what we're seeing is that, the first quarter, of course, has 2 months of no commentary about tariffs. It was only in March that the commentary started to be elevated. In April, of course, has been very volatile. So I think what we're seeing is first quarter results overall were better than expected. Credit's strong, capital levels are very healthy, liquidity's high. It's really the future and the unknown of the future that has everybody on edge.
How long do you think the elevated volatility, that the trading volume that comes from that, can make up for muted deal activity? Can that continue for a couple of quarters, or is there a limit to how far that could take you?
It's a really good question because it was outstanding in the first quarter, and it did more than offset, the lower numbers in some of the selected investment banking categories, particularly ECM, equity capital markets. The IPO market has really kind of fizzled out here due to this volatility. So you really need volatility and volumes to go with it to enable these larger firms to offset any slowdown in activity and advisory, which is M&A activity, of course, and then the ECM business. The DCM, debt capital markets, had a very strong first couple of months of the year. It has slowed down a little bit. So you're right, we will need to see elevated volumes and volatility if the investment banking markets don't come back. Ideally, if we could have some resiliency in the markets and less volatility, you might get a combination of lower revenues in trading, but more than offset by incremental pickup in the advisory and the ECM business. So we'll have to see how that plays out. But right now, the uncertainty is really weighing on the ECM and advisory business at this time.
Gerard, let's say we do see, a material economic slowdown in the U.S. How should investors think through what that would mean for your coverage universe?
It's a good question, and it's really the $64,000 question, because the biggest swing factor to earnings is credit and credit deterioration. And if we were to have a meaningful downturn, a bona fide recession that lasts, let's call it 6 to 12 months, in the summer of 2026, unemployment's approaching 8%, that would be very bad for the banks. No doubt about it. Credit losses would go much higher. and that and the stocks would suffer accordingly. But if we're in for a slower growth period or a mild recession, similar to what we saw in 01, 02, then the bank stocks are going to navigate through that much better than I think people realize. They have been de-risked ever since the financial crisis. They've been going through the annual stress test that is put on by the Federal Reserve, and this has forced the banks to take less risk on their balance sheets, so they should navigate through any slowdown better than they did, of course, in 08, 09. I would also point out that the capital levels are very strong. We're going to see, I think, a lot of capital actions this year in terms of share repurchases. The number yesterday, Goldman put up a $40 billion buyback program that they can on, and if they were to execute all of that, what's amazing to me is that that's over 20% of the shares outstanding for Goldman.
Gerard, looking broadly at leverage, if you look at the S&P 500, leverage looks really, really low, like almost all-time lows, and yet all we talk about are private credit markets. When you're doing your research and you're talking to executives, what do they think the real answer is? Is there a lot of leverage or a little leverage right now?
We're back.
Just repeat that.
Sure. Just to repeat the question, leverage is very low in the S&P 500, but all we talk about is private credit. And what is the right answer? When you talk to executives, do we have a lot of leverage or a little leverage in the system right now?
Yeah, it is really the right question to ask on credit, because the private credit sector has grown so meaningfully over the last 3 years, particularly since 2023. You might remember that was when the Federal Reserve introduced what they called at the time the Basel III Endgame proposal. And that proposal was going to require banks to carry considerably higher levels of capital. And the banks went on what they referred to at the time risk-weighted asset diets, meaning they were pulling back from lending, and the private credit markets seized the opportunity to grow more aggressively. So right now, the Bank of England has made an estimate that the private credit outstanding globally is well over $1.4 trillion. So there's certainly leverage out there in the private credit market. Generally, the banks do not have direct exposure here. There is a second derivative exposure where they're lending to some of the private credit lenders and the private equity players. And it'll be interesting to see if we go into a downturn. Quite often what happens in the past, what has happened in the past, is as the problems start to mount, the regulators force the banks to deal with the problems aggressively. You don't have that in the private credit markets. There's no regulator. So the private credit lenders can be more creative in the way they solve those problems. They could stretch out the payments. They could organize a payment in kind type of offering. They could be much more creative. So we may find out that the private credit markets, though they may be hit, could handle it better because they don't have regulators breathing down their back.
I think they used to call that extend and pretend back in the day.
Yes, you've got a good memory, or kick the can down the road.
Gerard, I'll end here. You have a few different buys, Gerard. If I was to pin you down, though, I said I need your number one pick. What would you tell me?
Josh, I would point to Wells Fargo, and the reason being they have the idiosyncratic issue of the asset cap. You might recall they've been sitting with the cease and desist order from the Federal Reserve since February of 2018, which included an asset cap. Secretary of the Treasury Bissett has made it very clear he wants the banks to get more involved lending in to the market. This would be a great way to back up the words with actions and have the Federal Reserve lift that asset cap. We believe it's going to happen this year, possibly in the second quarter of this year. So Wells would be the stock to own because we think they're going to get to grow finally after 7 years of being in purgatory.
And speaking of draw, we have Treasury Secretary Bissett coming up shortly. I know you'll be listening. Gerard, it is always great to have you, always great to listen to your analysis of the sector and get your picks, sir. Thank you so much for joining us.
Thank you, Josh. Thank you.
Shares of Hewlett Packard Enterprise jumping as activist investor Elliott Investment Management reportedly builds a position worth more than $1.5 billion in the company. Our next guest says this could change the AI landscape. The Epistrophe chief market strategist and host of the Drill Down podcast, the one and only Corey Johnson, join us now to discuss. Corey, it is great to see you. So let's get into these headlines, Corey, because they moved the name. Elliott Management, they build this position HPE per Bloomberg, $1.5 billion, makes Elliott one of the company's top 5 shareholders. Bloomberg saying, Corey, Elliott's exact intentions at HPE could not be immediately learned. But what do you make of all this?
Well, their intention for the stock price to go up. What do you mean it couldn't be learned? I mean, that's what Elliott does. They make investments with hopes the stock price will go up, and sometimes they're going to shake some cages to do so, to rattle some cages to do so. You know, I think this is an acknowledgement of HPE's really fantastic positioning in the world of AI and expanding their offerings in the AI world, where they're really in a strong place competing with Dell, competing with CoreWeave and others. This is not your grandmother's Hewlett Packard. You know, since the breakup in 2015, Antonio Neri has really led this company to be in a really strong place in the world of AI. And while the stock has been beaten up of late, it's created an opening here for Elliott Management.
And Corey, let me ask you, when you talk about their strong competitive position, what differentiates them there, Corey, from the Dells?
They a bunch of things. In particular, they've got some software offerings that are unique to what they're doing. But in some ways, they have some of the just top of the line products right up there with a Dell, where they've got the latest NVIDIA processors, they've got the latest optical networking in their systems, as referenced by the fact that Elon Musk's XAI has placed about $1.5 billion order with HPE, and they're sitting on billions in orders right now, ready to roll out these Hopper chips and really the most cutting edge design for the servers that they're selling. They're also a big leader in liquid cooling. And as we go forward in the world of AI and data center construction, the ability to keep these chips cool, to build really tightly clustered machines that are using copper to connect to each other, not just optical, but copper because they are so close, as they say at NVIDIA, copper while you can because it's so much cheaper. But because they're using liquid cooling, they can stack these things a lot closer than the sort of build out that other data center construction would require. And so they're in a really unique competitive space as we build out these big $100 billion AI data centers. HP is in a really strong place to do that.
Hey, Corey, it's Simeon Hyman. You know, we talked about this a little bit earlier in the show, just that older companies, not just the last generation, but these are companies from like 2 or 3 generations ago that are competing so well. I think of IBM, one of the highest returning tech stocks so far this year. How is it that these companies are innovating? How do you spell that? I don't even know how you spell it. But the ability to defy, to innovate as a legacy company, what is it that's allowing these companies to reinvent themselves?
I think it's leadership. I think, you've watched a lot of people come into HP, and I've watched this company really closely for a long time. And like IBM was a company you could always beat up on because they were taking, I think at one point I'd figured out it was like 11 years, maybe more years, where they were taking one-time restructuring charges because this thing was such a disaster before the breakup. But Antonio Neri is just doing a really strong job at this company, putting them in the right place to succeed, dealing with the really fast iterations of change that are necessary in an AI world, and making the right products at the right time. And again, I think the decisions to go towards liquid cooling and really understand what it's going to take to build out a modern data center, decisions that are made many years ago, are really starting to pay off for this company. And yes, the company got beat up. I think it was a -8% print on their server business, but that was during a changeover in NVIDIA chips when we were going from the older architecture to the newer architecture, the Blackwell architecture. And I think there was a hiccup we kind of saw across the industry. HP really got beat up for that. I think maybe because of that kind of legacy stank, if you would, on the name. But I think what we've seen from this company is really strong execution over the course of the last few years.